So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to answer another question, which is, should you manage an iron condor as two credit spreads? So again, this question came out of our Facebook community. Somebody asked in there and posted a comment, and they said, Kirk, assume you have two credit spreads. Do you have an opinion as to if these need to be sold simultaneously, or could you try to watch the price a bit and sell the put credit spread and the call credit spread at two different times, hopefully optimizing either entry or exit? And so conceptually, I think this makes a lot of sense why you would want to manage a position as two separate spreads, right? If the market is down potentially and looks like it could be going back up, maybe you sell the put spread and then later you add the call spread after the market's rallied. I think conceptually, it makes a lot of sense why you can do it. I think in reality and in practice, I don't think it's as easy to do it because we're still trying to pick direction and movement of this underlying security. And I think that's still really hard to do. So I understand when people ask this question. And again, in theory, it works really, really well, but the reality or the practice of it doesn't work as well. So I would generally default to not managing it as two separate spreads. I would manage it as one single position, and I would then use the opportunity to ladder into different contracts as a means to basically accomplish the same thing without having to sell one side first and then add the other side. What I see as being potentially harmful to this type of strategy is that if you sell one side of a credit spread, for example, assuming you're going to do the iron condor later on, the stock could move against you very quickly and you have a massive loss on your hands. You would have been better served had you taken in the additional credit from selling the other call spread side at the same time. It would have, kind of reduced some of the pain from the stock moving against you. So I'm more of a fan of spreading the trade out over time, just doing more laddered entries as opposed to doing separate spreads. This isn't to say, though, that we don't do spreads individually to help balance out the portfolio, and we'll do one side of a position knowing that we could adjust into an existing iron butterfly or iron condor later, but that's more of a means to balance out other positions in the portfolio. So, for example, if our portfolio is really bullish and we need some bearish positions, we might deliberately go out and sell a call credit spread on something because that's what the portfolio needs at the time. We want to make sure that individual position is still a good position, high probability of success, adds diversity, but we don't need to do the full iron condor or iron butterfly because what the portfolio needs is more bearish exposure. So that's why we would sell the call spread. So hopefully this helps out. As always, if you have any questions, let me know. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.